Our next guest is predicting a hard landing for the U.S. with the recession beginning mid-year. Joining us now, Post 9, to discuss is Citigroup Chief U.S. economist Andrew Hollenhorst. Still a pretty, I would say, outlier view at this point to expect a recession this year.
Yeah, I think that's right. And there's this very powerful and seductive narrative around this being a soft landing, and we're just not seeing it in the data. I think that's what we've seen over the last couple of days. We have inflation that's running too high. The activity data is more debatable. January, you have some big seasonal factors, so I think that's part of why markets are a little bit skeptical of these numbers. But it was a pretty big decline in retail sales that we saw this morning.
Sorry, I called you Alan. It's Andrew. I would argue that all the data has pointed to better economic growth, from GDP to jobs. Even manufacturing appears to be picking up. It feels like at the end of 2023 and into 24, there was an acceleration in the economy. And if you look at retail sales, maybe you can question the strength of the consumer, but there's also weather and there's also a give back from holiday.
So I think you're absolutely right. That's where we were as we ended 2023. And it was a remarkable year in terms of above 3% real GDP growth. Very few people were forecasting that. We were not forecasting that. We were surprised to the upside. But the question is, where are these forward-looking indicators showing us that we're going to go? We just got a really strong jobs report, over 350,000 people hired. But within that jobs report, the number of hours that people are working is going down. The number of full-time workers is going down. In certain sectors like restaurants, you're not seeing that hiring. And I think that's the key to the economy, is what happens in the labor market. If the unemployment rate stays low, people continue to spend, the economy holds up. But if that unemployment rate starts rising, and we think it will, and I think we saw some of that in continuing jobless claims this morning, that's the sign that we're going to have a more material decline in activity in the U.S. economy.
Yeah, we had a discussion about that earlier today. Add to that, CapEx plans don't look all that hot. There's continued discussion about whether or not the consumer's excess savings is finally reaching a level where it's just nowhere near where it was at the peak.
I think we see some of that in the data, particularly in the credit card delinquency data. We just got some new data on that out last week. And you see those delinquencies that are rising. And what that's telling you is that there may be some consumers out there that still have excess savings. But those consumers that are exposed to floating rate credit card debt at much higher rates now, that have been pulling on those excess savings to continue to consume, continue to spend, now those delinquencies are picking up. So I think you are starting to see some of that weakness in the data.
So if we started to see marked weakness, does that mean that any rate cut path would be more dramatic than maybe the market's pricing in right now?
So the Fed has a very, very difficult task here, because they're using a blunt tool to try to navigate between their dual mandate, full employment and stable prices. If you were to see initial jobless claims rising, if you were to see the unemployment rate rising, that's a very clear signal to the Fed to be cutting interest rates. The issue, though, is they have to balance that with inflation. And that's the other data that we got this week. Inflation actually continuing to come in stronger. And I think that's the basic macroeconomic problem that the Fed faces. You lower interest rates, that's going to support the economy, but that's also going to boost inflation.
Are you raising a stagflationary flag?
So I think if we get this slowing in the economy, then that probably will bring down inflation. What I'm really pointing to here is that a soft landing is the least likely scenario, because as the Fed tries to avoid the soft landing by adjusting interest rates, you either over-adjust one way or the other.
All right, so to recap, he said the soft landing is the least likely scenario. He expects a mid-year recession this year. He does not see a soft landing in the data. There was a big decline in retail sales this morning. He thinks unemployment will continue to rise this year. He says consumers are pulling on excess savings, which means less spending on stocks and in the economy. There was a really strong jobs report, but the hours worked is going down per person. He said the Fed can only do so much because they're working with blunt tools. We've known this. They're working with lagging indicators. So he's positioned for a hard landing, guys. And if you saw on the screen there, at one point, there were 29 companies laying off workers in 2024. So that's just a little recap, guys. I hope you enjoyed. Hope you learned something. I'll see you in the next one.